Hey everyone! Welcome back to UBC Real Estate Exam Prep. Today we're covering Chapter 23, the Income or Investment Approach of Appraisal, Lesson 18. This method is used to value income-producing properties by analyzing rental income, expenses, and cap rates. It's key for investors and real estate professionals. By the end of this video, you'll understand NOI, cap rates, and how to calculate market value. Don't forget to like, subscribe, and hit the bell for more exam prep tips. Let's get started. Question 1. Which one of the following items is deducted from gross realized income to arrive at net operating income when preparing an appraisal using the income approach? Correct answer. Option 3. Real property taxes are deducted from gross realized income to determine net operating income in the income approach. Step 1. Understanding gross realized income and net operating income, NOI. Gross realized income, GRI. This is the total income generated by a property before expenses. It includes rent, parking fees, and other revenue sources. Net operating income, NOL. This is the income left after deducting operating expenses from gross realized income. Operating expenses, these are necessary costs to maintain and operate the property, e.g., property taxes, maintenance, and insurance. C. Real property taxes, correct. Real property taxes, also called property taxes, are part of the regular costs associated with owning and maintaining an investment property. Since these are ongoing operating expenses, they are deducted from gross realized income to determine net operating income. Other options analysis. A. Income tax, incorrect. Income tax is paid on profits and is a personal or corporate expense. It is not part of the property's operating expenses. Net operating income is calculated before considering income tax. B. Interest on the mortgage, incorrect. Mortgage interest is a financing expense, not an operating expense. Net operating income only considers expenses related to the property's operation, not how it is financed. D. Depreciation expense, incorrect. Depreciation is an accounting adjustment that spreads the cost of the building over time. It is not an actual cash expense and is not deducted to calculate net operating income. Question 2. You are determining the market value of a subject property using the capitalization process. The gross potential rent for the subject property is $430,000, operating expenses are $130,000, and the long-term vacancy rate is 4%. If immediate repairs of $65,000 are required on the property and the appropriate capitalization rate is 6%, the market value of the property is approximately. Step 1. Understanding the capitalization process. The capitalization approach determines a property's market value by converting its net operating income, NOI, into a value using a capitalization rate, cap rate. The formula is market value equals NOI divided by cap rate. If there are immediate repair costs, they must be deducted from the calculated market value. Step 2. Determine the net operating income, NOI. We are given gross potential rent, GPR, equals $430,000. Vacancy rate equals 4%, which leads to vacancy loss equals $430,000 times 0.04 equals $17,200. Operating expenses equals $130,000. Now calculate net operating income. NOI equals GPR minus vacancy loss minus operating expenses. NOI equals $430,000 minus $17,200 minus $130,000 equals $282,800. Step 3. Apply the capitalization formula. Market value equals $282,800 divided by 0.06. Market value equals $4,713,333. Step 4. Deduct immediate repairs. Immediate repairs equals $65,000. Final market value equals $4,713,333 minus $65,000 equals $4,648,333. Rounded to $4,648,000. Final answer, D. $4,648,000. Question 3. Which one of the following statements is true? The correct answer is D. The capitalization rate applied to the net operating income of an investment property is related to the yield on comparable investment properties. Explanation. A. Given that the net operating income remains constant, the market value of a property rises as the required yield rises. Incorrect. If the required yield capitalization rate increases, the market value decreases, given that net operating income, NOI, remains constant. The market value is calculated as market value equals NOI divided by cap rate. So, as the cap rate rises, the denominator increases, leading to a lower market value. B. The market value of an income-producing property is best determined by averaging the sale prices of any 3 other income-producing properties that have recently sold. Incorrect. The market value of an income-producing property is not best determined by simply averaging sale prices of 3 other properties. Instead, it should be based on the expected yield cap rate that investors require. C. In the determination of an income-producing property's market value, the terms gross realized income and net operating income are synonymous. Incorrect. Gross realized income and net operating income, NOI, are not the same. Gross realized income refers to total rental and other income before expenses, while net operating income is calculated after subtracting operating expenses. D. The capitalization rate applied to the net operating income of an investment property is related to the yield on comparable investment properties. Correct. The cap rate reflects the yield that investors require, based on comparable investment properties. If investors demand higher returns, cap rates increase, impacting valuations accordingly. Question 4. In applying the income approach, depreciation is excluded from operating expenses in the calculation of net operating income. Which one of the following statements is an explanation for why depreciation is excluded? The correct answer is D. The life of a building is primarily determined by economic factors rather than physical condition. Explanation. Net operating income, NOI, is calculated before accounting for depreciation because net operating income represents the income generated by a property based on its current operation, not its accounting or tax deductions. Depreciation is an accounting expense that does not affect the actual cash flow of the property. The economic life of a building, how long it remains valuable, is more important in valuation than its physical wear and tear. Since NOI focuses on actual operating income rather than accounting expenses, depreciation is excluded. Why other options are incorrect? A. Depreciation measures a loss in value that occurs despite regular repairs and maintenance. Incorrect. While this is true, it does not explain why depreciation is excluded from net operating income, NOI, calculations. NOI only considers actual operating expenses, not accounting deductions. B. Depreciation affects only the building component of the property. Incorrect. While depreciation applies mainly to the building, not land, this does not explain why it is excluded from net operating income. NOI focuses on the property's income and expenses, not accounting adjustments. C. Depreciation expense is excluded from calculations for income tax purposes. This is false. Depreciation is actually included as an expense for tax purposes, reducing taxable income. However, net operating income is calculated before tax considerations.
Question 5. Consider the following data related to recently sold properties A and B. They are comparable to the subject property C. Using the limited data above, estimate a market value for property C, rounded to the nearest $1,000. Comparable A. Net operating income, $38,000 minus $25,000 minus $3,800 equals $9,200. Cap rate, $9,200 divided by $190,000 equals 0.0484211. Comparable B. Net operating income, $49,000 minus $32,000 minus $4,900 equals $12,100. Cap rate, $12,100 divided by $220,000 equals 0.055. The cap rate used to calculate the market value of the subject property is the one that most reflects the subject property and is determined by several factors. For the purposes of this question, the 2 most comparable properties have been selected and a range of values is determined. Subject property. Net operating income equals $54,000 minus $36,000 minus $5,400 equals $12,600. Sale price using cap rate from comparable A. Sale price equals net operating income divided by cap rate equals $12,600 divided by 0.0484211 equals $260,217 or $260,000, rounded to the nearest $1,000. Sale price using cap rate from comparable B. Sale price equals net operating income divided by cap rate equals $12,600 divided by 0.055 equals $229,090 or $229,000, rounded to the nearest $1,000. The subject property's market value estimate is in the range of $229,000 to $260,000, rounded to the nearest $1,000.
Question 6. Which one of the following is true with respect to the estimate of vacancy rates in the appraisal of income-producing properties? Correct answer D. Vacancy rates are needed because the 100% occupancy assumption of gross potential revenue is unrealistic for most properties. Explanation. Gross potential revenue assumes a property is fully occupied, but in reality, vacancies, tenant turnover, and unpaid rent occur. Appraisers account for vacancy rates based on market data to estimate realistic income projections. Why the other options are incorrect? A. Vacancy rates are expressed as a percentage of net operating income. Incorrect, because vacancy rates are expressed as a percentage of gross potential revenue, GPR, not net operating income. B. Vacancy rates are considered an operating expense. Incorrect, because vacancy loss is an adjustment to revenue, not an expense. Operating expenses cover costs like maintenance and utilities. C. Vacancy rates can be ignored if the subject property has never had any vacancies. Incorrect, because appraisals consider market trends rather than a single property's past performance. Question 7. Which one of the following is false with respect to the estimate of vacancy rates in the appraisal of income-producing properties? The correct answer is B. Vacancy rates must be those existing at the time of the appraisal for the subject property. False statement. Why is this false? Vacancy rates should be based on long-term market trends in the area, not just the current vacancy of the subject property. Appraisers look at vacancies in comparable properties and adjust for future expectations. Why the other options are true? A. Vacancy rates are expressed as a percentage of gross potential revenue. True. Vacancy rates are calculated as a percentage of potential rental income, not net operating income. C. Vacancy rates are needed because the 100% occupancy assumption of gross potential revenue is unrealistic for most properties. True. Most properties experience some vacancies, so appraisals always factor this in. D. Vacancy rates must be deducted from gross potential revenue. True. To determine effective gross income, EGI, vacancy losses are subtracted from gross potential revenue. Question 8. An estimate of gross potential rents is achieved by. The correct answer is B. Comparing rents for recently leased similar space. Explanation. Gross potential rent, GPR, represents the total income a property could generate if fully leased at market rents, not necessarily current rents in the building. The best way to estimate market rent is by analyzing recent leases of similar properties in the same area. Why the other options are incorrect? A. Comparing all rents for similar space. Incorrect, because some rents may be outdated or based on old lease agreements, which do not reflect current market conditions. C. Projecting future rental increases. Incorrect, because gross potential rent is based on current market conditions, not future speculations. D. Totaling current rents in the subject building. Incorrect, because existing rents may not be at market value. Some tenants may be paying above or below market rates due to old leases or negotiated terms. Question 9. Which one of the following would not be included in the operating expenses of a commercial property for purposes of determining its market value? The correct answer is B. Interest on the mortgage. Incorrect, not included in operating expenses. Here's why. Operating expenses include costs necessary to maintain and operate the property, excluding financing costs. Mortgage interest is a financing expense, not an operating expense, because it depends on how the property is financed rather than its actual operations. Why the other options are included in operating expenses? A. Reserve for replacement of equipment. Correct, included. This accounts for future repairs or replacements, e.g., HVAC systems, elevators. C. Property taxes, correct, included. Property taxes are a recurring expense required to operate the property. D. Advertising of vacant suites, correct, included. Marketing expenses to attract tenants are part of the cost of running a commercial property. Question 10. A property recently sold for $378,500. The stabilized net operating income for the property was estimated to be $75,700 per annum. The estimated yield to the buyer is? To calculate the estimated yield capitalization rate, use the formula cap rate equals net operating income NOI divided by purchase price. Given NOI equals $75,700. Purchase price equals $378,500. Calculation. Cap rate equals $75,700 divided by $378,500 times 100. Therefore, 0.20 times 100 equals 20%. Correct answer, A, 20%. Question 11. You have been asked to appraise an apartment building using the income approach of appraisal. You have been given the following data relating to recently sold properties A and B. They are comparable to the subject property C, whose value is to be appraised. Using the limited data found above, which of the following is the best estimated range in market value for subject property C, rounded to the nearest $1,000? The cap rate used to calculate the market value of the subject property is the one that most reflects the subject property and is determined by several factors. For the purposes of this question, the two most comparable properties have been selected and a range of values is determined. Find the cap rate. Comparable A. Net operating income equals $51,000 minus $32,000 minus $4,080 equals $14,920. Cap rate equals $14,920 divided by $234,000 equals 0.063767. Comparable B. Net operating income equals $44,000 minus $28,000 minus $3,520 equals $12,480. Cap rate equals $12,480 divided by $211,000 equals 0.0591469. Subject property. Net operating income equals $48,000 minus $30,000 minus $3,840 equals $14,160. Sale price using cap rate from comparable A equals $14,160 divided by 0.063767 equals $222,080 or $222,000, rounded. Sale price using cap rate from comparable B equals $14,160 divided by 0.0591469 equals $239,404 or $239,000, rounded. Therefore, the best market value estimate would be $222,000 to $239,000, rounded to the nearest $1,000. Question 12. You have been asked to appraise an apartment building using the income approach of appraisal. Although the current rents on the subject property are $270,000, you suspect the building is poorly managed. Your research indicates that the subject property's gross potential rent is $310,000. The operating expenses on the apartment building being appraised are expected to be $87,900. The following comparable building, similar to the subject property, was sold recently. Based on the information from the comparable, determine the market value of the subject property, rounded to the nearest $1,000. Step-by-step breakdown. Step 1. Find the cap rate from the comparable property. We are given gross potential rent GPR of property A equals $312,800. Vacancy rate equals 5%. Vacancy loss equals 0.05 times $312,800 is equal to $15,640. Operating expenses equals $88.20. Sale price of property A equals $2,190,000. Net operating income for property A. Net operating income equals GPR minus vacancy loss minus operating expenses. Gleich 312,800 minus 15,640 minus 88,200 equals 208,960. Cap rate calculation. Cap rate equals NOI divided by sale price equals 208,960 divided by 2,190,000 equals 0.095455 or 9.54%. Step 2. Subject properties net operating income. $310,000 minus 005 times $310,000 minus $87,900 gleich $206,600. Sale price equals $206,600 divided by 0.095455 equals $2,165,267, rounded to $2,165,000. Question 13. Which one of the following items is not likely to be available to an appraiser valuing a commercial property? The correct answer is the buyer's expected rent and expense forecasts. Explanation. An appraiser cannot access a buyer's personal financial expectations, as this information is private and not publicly available. Why the other options are available to an appraiser. Current lease conditions at the time of sale of the property. Lease agreements are often available through property records, market data, or direct access to landlords. The amount of any registered mortgages. Mortgage details can be found in public land title records. Physical characteristics of the building. Appraisers can access building plans, inspections, and site visits to evaluate property characteristics. Question 14. Operating expenses for appraisal purposes include. The correct answer is B. Property taxes. Explanation. Property taxes are a necessary cost of operating a property and are included in net operating income, NOI, calculations for appraisal purposes. Why are the other options incorrect? A. Income taxes incorrect. These are owner-related taxes, not directly tied to property operations. C. Mortgage payments incorrect. These include principal and interest, which are financing costs, not operating expenses. D. Capital cost allowance CCA. Incorrect. CCA, depreciation for tax purposes, is an accounting deduction, not an actual expense for running the property. Question 15. A property recently sold for $800,000. The stabilized annual net operating income for the property is $88,000. The yield on this property is. Find the yield of the property given the net operating income and the sale price. Yield equals net operating income divided by sale price. Yield equals $88,000 divided by $800,000. Yield equals 11%. Question 16. Comparable, ABC, has a gross potential rent of $124,000, operating expenses of $44,000, and a sale price of $635,930. Comparable, XYZ, has a gross potential rent of $138,000, operating expenses of $50,000, and a sale price of $711,000. The long-term vacancy rate is 4%. Based on the above, the market yield is estimated to be between. In this question, calculate the net operating income in order to find the market yield for each comparable. Net operating income equals gross potential rent minus operating expenses minus vacancy rate. Market yield equals net operating income divided by sale price. Comparable ABC. Net operating income equals $124,000 minus $44,000 minus 0.04 times $124,000 equals $75,040. Market yield equals $75,040 divided by $635,930 equals 11.8%. Comparable, XYZ. Net operating income equals $138,000 minus $50,000 minus 0.04 times $138,000 equals $82,480. Market yield equals $82,480 divided by $711,000 equals 11.6%. Thus, the market yield is between 11.6% and 11.8%. Question 17. Assume the net operating incomes of office buildings in your area have remained steady while the market capitalization rate has gradually fallen over the last year. This would mean the correct answer is A. The sale prices of office buildings have risen. Explanation. The market capitalization rate, cap rate, is used to value income-producing properties. Market value equals net operating income, NOI, divided by cap rate. If net operating income remains steady but the cap rate decreases, the denominator in the equation gets smaller. A smaller denominator means a higher market value, so property prices rise. Thus, option A is correct. Question 18. Which one of the following is the best method of accounting for cyclical repairs in the appraisal of an income-producing property? The correct answer is C. Apportion the amount of the repair to an annual allowance. Explanation. In the income approach, cyclical repairs, such as repainting or replacing a roof, occur periodically but should be accounted for annually to ensure a stable net operating income, NOI. This is done by setting aside an annual allowance, reserved for replacements, to spread out the repair cost evenly over time. Example, if a repair costs $15,000 and occurs every 3 years, an annual allowance of $5,000 per year would be deducted as an expense. Thus, option C is correct. Question 19. In appraising an income-producing property using the income approach, gross potential rents must be estimated. How are gross potential rents best determined? The correct answer is D, based on current market rents of similar properties. Explanation. Gross potential rent represents the maximum rental income a property could generate if fully occupied at market rates. The best way to estimate this is by analyzing current market rents for comparable properties in the area. Even if a property is fully rented, its actual rents may be outdated or below market value, so appraisers must compare to similar recent leases. Thus, option D is correct. Question 20. The potential buyer of an apartment block has asked an appraiser to do an appraisal of the apartment block in order to determine its market value. The following information has been made available to the appraiser. Estimated annual gross realized income is $44,200. Estimated long-term vacancy allowance is 4%. Estimated annual operating expenses are $17,850. In addition to this information, the appraiser has found a similar property with an effective annual yield of 7.85%. Given the above information, the final estimate of value for the subject property, rounded to the nearest $1,000, on the date of valuation is. For this question, calculate the NOI from the information given. Then, use the given yield/cap rate on the comparable property to estimate the value of the subject property. Note that gross realized income is given, not the gross potential income. This means that you only have to deduct expenses from gross realized income to determine NOI. Estimated value equals net operating income divided by cap rate or yield equals $26,350 divided by 7.85% equals $335,668.79, or $336,000, rounded. Net operating income equals gross realized income minus expenses, so $26,350 equals $44,200 minus $17,850. The subject property's market value estimate is $336,000, rounded to the nearest $1,000. Question 21. Miss A, appraiser has the following data related to recently sold properties A and B. These properties are comparable to the subject property C, whose value is to be appraised. Long-term market vacancy rates are 5%. Using the information above, what should Miss A, appraiser estimate as an approximate market value for the subject property, rounded to the nearest $1,000? Note, we are given the gross realized revenue, so vacancy is already included. A reminder, gross potential revenue minus vacancy equals gross realized revenue. Find the yield/cap rate of comparable A and B, then determine a range for the market value of the subject property using these two cap rates. A, $47,000 minus $29,000 equals $18,000 divided by $210,000 equals 8.571429%. B, $52,000 minus $34,000 equals $18,000 divided by $225,000 equals 8%. Subject property, net operating income equals $56,000 minus $37,000 equals $19,000. Market value using cap rate from comparable A. Market value equals $19,000 divided by 8.571429% equals $221,666.67, or $222,000, rounded. Market value using cap rate from comparable B. Market value equals $19,000 divided by 8% equals $237,500, or $238,000, rounded. The subject property's market value estimate is in the range of $222,000 to $238,000, rounded to the nearest $1,000. Question 22. The income approach is not usually used for the valuation of. The correct answer is A, single-family residences. Explanation. The income approach is mainly used for properties that generate rental income, such as apartment buildings, office spaces, and commercial properties. Single-family residences are typically bought for personal use, not as income-producing investments, so their value is usually determined using the comparative market approach, sales comparison. Warehouses, leasehold interests, and retail complexes are often income-generating, making them suitable for the income approach. Thus, option A is correct. Options 2, 3, and 4 are incorrect because this approach can be used in appraising most types of property, although it is more appropriate for properties that produce rental income, e.g., apartment buildings, office buildings, industrial space. Question 23. As an appraiser working for a large investment firm, you have been asked to determine the value of a small commercial building that produces a net operating income of $48,700 per annum. If the market capitalization rate for similar investments is J1 equals 20%, the market value of the property is. Since you would sell the house for its market value, the market value and sale price are the same. Sale price equals net operating income divided by cap rate equals $48,700 divided by 0.20 equals $243,500. Question 24. Consider the following data related to recently sold properties A and B. They are comparable to the subject property C, whose value is to be appraised. Based on the limited information indicated by the sale comparables, which of the following is the most accurate market value range for property C, rounded to the nearest $1,000? For this question, use the following three formulas. Market value equals net operating income divided by cap rate. Cap rate equals net operating income divided by market value. NOI equals gross potential income minus vacancy minus current operating expenses. Calculate the net operating income for each of the three properties and the cap rate for the two comparable properties. Comparable A. NOI equals $45,000 minus $4,500 minus $30,000 equals $10,500. Cap rate equals $10,500 divided by $210,000 equals 0.05. Comparable B. NOI equals $49,000 minus $4,900 minus $32,000 equals $12,100. Cap rate equals $12,100 divided by $220,000 equals 0.055. The cap rate used to calculate the market value of the subject property is the one that most reflects the subject property and is determined by several factors. For the purposes of this question, the two most comparable properties have been selected and a range of values is determined. Subject property, NOI, equals $54,000 minus $5,400 minus $36,000 equals $12,600. Market value using cap rate from comparable A. Market value equals $12,600 divided by 0.05 equals $252,000. Market value using cap rate from comparable B. Market value equals $12,600 divided by 0.055 equals $229,090.91, or $229,000, rounded. The subject property's market value estimate is in the range of $229,000 to $252,000, rounded to the nearest $1,000. Question 25. A property listed for sale has a net operating income of $15,763 per annum that is assumed to be perpetual and constant. The market capitalization rate is 9.5% per annum. What is the maximum price a prudent investor should pay for this property? Explanation: the value of an income-producing property is determined using the capitalization formula. Market value equals net operating income, NOI, divided by capitalization rate. Given, NOI equals $15,763 per annum. Capitalization rate equals 9.5%, 0.095. Market value equals 15,763 divided by 0.095 equals 165,926.32. Thus, the maximum price a prudent investor should pay is $165,926.32. Question 26. Which of the following statements regarding the income approach of appraisal is true? The correct answer is C. Net operating income does not consider depreciation, income tax, or debt service. Explanation: net operating income, NOI, is calculated as gross income minus operating expenses but excludes depreciation, as it is a non-cash accounting expense, income tax, as it varies by owner, debt service, mortgage payments, since financing is specific to each owner. Why the other options are incorrect? A. Net operating income is a measure of return on the equity portion of a property's value. Incorrect. NOI represents a return on the entire property value, not just the equity portion. B. Items specific to an owner or investor are included in the calculation of net operating income. Incorrect. NOI excludes owner-specific expenses, e.g., personal loan payments or unique business costs. D. The income approach is only used for apartment buildings. Incorrect. The income approach is not limited to apartment buildings. It applies to all income-generating properties, e.g., offices, warehouses, and retail spaces. Question 27. Consider the following data related to two recently sold properties, Property A and Property B. They are comparable to the subject Property C, whose value is to be appraised. Using the limited data above, estimate a market value for Property C, rounded to the nearest $1,000. Comparable A. Net operating income, $36,000 minus $25,000 minus 0.05 times $36,000 equals $9,200. Cap rate, $9,200 divided by $190,000 equals 0.04842111. Comparable B. Net operating income, $47,000 minus $32,000 minus 0.05 times $47,000 equals $12,650. Cap rate, $12,650 divided by $250,000 equals 0.0506. The cap rate used to calculate the market value of the subject property is the one that most reflects the subject property and is determined by several factors. For the purposes of this question, the two most comparable properties have been selected and a range of values is determined. Subject property. Net operating income equals $54,000 minus $36,000 minus 0.05 times $54,000 equals $15,300. Sale price equals NOI divided by cap rate equals $15,300 divided by 0.0484211 or equals $15,300 divided by 0.0506 equals $315,978 rounded to $316.000 and $302.372 rounded to $302,000. The subject property's best estimate market value is in the range of $302,000 to $316,000, rounded to the nearest $1,000.